Let's get more from Martin Pelletier, Senior Portfolio Manager at Wellington-Altus Private Counsel based in Calgary. Martin, great to see you. Always great to get your insight. The Trump administration, Trump's team say, well, look, businesses will adjust. That's what businesses do. So the sun's going to rise tomorrow. We don't have to subsist on canned goods. Are you interested in stocks right now? Are you buying or are you staying clear?
We're not buying yet, but doesn't mean we aren't sharpening our pencils here. I don't think the market's hit the bottom. You still have retail that have been strongly buying these dips. Credit spreads are still holding up, and 10-year yields, if you look at the U.S. 10-year yield, still went back above 4%. So there still is that tail risk that can still hit the markets. And so we don't know how that's going to shake out should this be a longer-term structural shift. That doesn't mean that there aren't opportunities out there, but you have to be very careful not to catch a falling knife.
When you say credit spreads, meaning that corporate bonds, people are still willing to accept modest yields on corporate bonds despite the risk?
Yeah, and even high yield bonds, junk bonds, the yields are not compensating for the amount of risk out there. If this is a pervasive trade war that goes on longer than what many are expecting, and it's not an art of the deal negotiating tactic, then there could be some more downside and some serious tail risk here. And so bond markets are not telling you that at this point in time, and so we're just being a little cautious. But have our trades lined up. So if we get continued volatility, then we can start layering in.
The Prime Minister, or should I call him the Liberal leader, Mark Carney, stating the obvious. I guess that's the thing central bankers and ex-central bankers do. If America goes into recession, we'll suffer. What is your view on investing in Canada right now?
Yeah, so we have to be careful about stock markets and economies because sometimes they'll do different things. I do think Canada is going to be more exposed. We saw that with the job numbers last week economically, and we just don't have the means to compete against the U.S. Our productivity is low. Our GDP per capita is still abysmal. So from that standpoint, it's not a high growth economy. However, that said, there are some good companies here that are somewhat isolated and protected due to their oligopoly type of structures, due to their pricing structures. So some of the Canadian utility sectors, the healthcare, looking at the banks, they've sold off a little bit here. And so I think there's potential for Canadian TSX companies to do better than the U.S. just because of the very nature that they didn't participate in the growth that we saw the last 2 years, but they're also not getting hit the hardest due to these tariff risks.
What about oil? What's your thought there? Oil not far off 4-year lows.
Yeah, that one's really been interesting. I went out to Vienna and met with OPEC, which was really fascinating. We had pulled back and reduced our energy exposure in January, fortunately, significantly by 50 to 60%. And so I was getting a few jabs from some of the other people that were attending this event in Vienna about me being a little bearish. Unfortunately, that's worked out okay, and I didn't want to be right. But if this recession does turn into a recession into the U.S., that's going to impact U.S. oil demand, and they're the biggest consumer. And so Trump does want lower oil prices. So maybe it wasn't a coincidence that OPEC announced an increase in output at the same time Trump wants lower oil prices. Who knows? I love conspiracy theories. And so that's going to impact the sector, and it's been hit pretty hard. Having said that, you got companies like CNQ, Canadian Natural Resources, their break-even oil price is at $40 US a barrel. We're still at 60. Maybe U.S. shale companies can't make money at 60, but Canadian companies sure can.
Yeah, and I mean, if you buy CNQ now, I'm just checking the yield. You lock in that pretty solid yield. I mean, we know Murray Edwards will be loath to cut it. Yeah, a yield of about 6% today.
Yeah, no, that's a good dividend. And they've got a strong balance sheet to be able to maintain that. Oil prices, even with the oil prices at $60, they're generating some good cash flow. Oil differential is still half decent in the Canadian dollar. I mean, you guys get paid in U.S. dollars, so that's one of our ones that we're looking at adding on our list here should it continue to sell off, because we already reduced our exposure, as I had mentioned. It's tempting to get back in again, but we'll have to play that by ear.
A lot of your client base are people in early retirement. So I guess in a lot of cases, they have 20 years or more to go before they stop getting interested in money. Let's put it that way. So you think sometimes, are they too risk averse?
No, so it just depends. A lot of like our clients per se have taken a lot of risk, and they've generated a significant amount of wealth through their careers, being professionals or being entrepreneurs. And so if they can get, 6, 7, 8% returns and mitigate the downside as much as possible, then their lifestyle is not being impacted during retirement. So they can still do their trips, maybe not going to the US anymore, maybe going to Europe. So it's just a whole different mindset and a different philosophy. And, they're thankful for, we're not getting any calls, so thankful for the risk management during times like these, because they don't have to worry about cutting down on their spending or their trips because of markets. And, that's not a bad place to be. For younger investors, you probably do want to take a lot more risk with your portfolios. If you've got if you're in your 30s and you want to save up for a home, and well, in Canada, that's going to be a tough job. But all of a sudden, markets are that much cheaper.
It's interesting you mentioned travel. Mike Bird, who is the Wall Street editor for The Economist, has just retweeted a chart from Goldman that he says shows a slump in overseas passengers arriving to the US. He reckons some of it is who wants to be harassed at the border. But in any case, maybe we could put up Air Canada. Do you think Air Canada will have to update its disclosure on weakness in US travel?
I think all of them are going to have to do that and readjust their flight routes. There is some anxiety to be justified. My son is going to Oregon in 2 weeks, and he's 19 and a young whippersnapper. And if he was like me at 19, then I'd be in a world of trouble down there. So we want to be careful about that. And I think other parents and other people are asking the same kinds of questions, and they're redirecting their travel to other jurisdictions. And I can't blame them. So, yeah.
Yeah, I just had a daughter fly to California, and we were apprehensive, but she landed safely, I'm glad to say. Yeah, I told her not to provoke them in any way. Leave us with a final thought, Martin. Do you think Trump, you touched on this at the beginning, do you think Trump and his team will back down in some way here?
I do. This is not a long-term Brexit type of situation, in my opinion. But it's going to last longer until we start to see, we're still in the early innings per se, and there's going to have to be some more pain and negotiations to be had before we get to where we get to. And so that means markets probably have some more downside. But he can't be that stupid, to be honest. I'm going to use a strong term there, because if this continues indefinitely, it will really be quite painful to the U.S. and the U.S. consumer. And so I don't think we're going to see the full extent of what's being talked about. But there's a big stick being waved around right now, and that's going to continue probably for the next couple of weeks.
Martin, thanks very much indeed. Martin Pelletier, Senior Portfolio Manager at Wellington-Altus Private Counsel in California.